Welcome to vTalkInsight, Allocator's Lens Daily for April 8th, 2026. Energy markets are flashing red, while equity and credit volatility stay surprisingly contained, creating a growing disconnect in cross-asset risk pricing. Today we look at how the oil shock, inflation data, and a patient Federal Reserve are reshaping the opportunity set across equities, rates, credit, currencies, and commodities. In equities, the central tension is between remarkably resilient earnings and a powerful energy shock that threatens growth. Despite oil roughly doubling since January and headline risk around Iran and the Strait of Hormuz, broad U.S. equity benchmarks have held up, with volatility measures in the mid-20s rather than at crisis levels. Corporate America is still expected to deliver around 13% year-over-year earnings growth and maintain strong net margins, and this quarter could mark a sixth straight period of double-digit profit expansion. Energy companies are a big part of that story, with higher crude prices lifting their earnings estimates and providing a cushion to index-level profits, even as fuel becomes more expensive for the rest of the economy. Leadership within equities remains highly concentrated in technology and the broader artificial intelligence ecosystem. Semiconductor stocks have outperformed, with the main chip index up strongly year-to-date, and Samsung's latest quarter showed an eightfold jump in profit, driven mainly by surging demand and higher prices from memory tied to AI workloads. Deals like Broadcom's expanded multi-year agreement to supply custom AI chips to Google, and Arm's pivot toward data centers and generative AI, underline how capital and earnings momentum are clustering around compute and infrastructure plays. At the same time, recent price action highlights selectivity. Samsung shares closed lower despite the blowout quarter, and European tech names, such as ASML, have come under pressure from tightening U.S. export restrictions to China, even as some U.S. chip makers continue to rally. The risk side of the equity ledger is dominated by the energy shock and its impact on consumers. History shows that sustained oil price doubles have often preceded equity drawdowns of 20% or more, and today airlines, transport, and other energy-intensive sectors already face sharply higher costs as jet fuel and diesel prices surge. High fuel bills effectively tax households, and with consumption making up the bulk of U.S. economic activity, prolonged pain at the pump would challenge the optimistic earnings profile that currently supports valuations. Yet options markets, several months out, are not pricing much fear. Demand for longer-dated index hedges is subdued, and a large pool of cash and money market funds sits on the sidelines, ready to re-engage if confidence improves. That combination of narrow leadership, benign volatility, and a large cash buffer means the path for equities may hinge on how quickly energy tensions ease and whether the upcoming earnings season confirms or begins to undermine the current growth narrative. Turning to rates, bond markets are wrestling with an energy-driven inflation pulse and central banks that are in no rush to move. U.S. inflation data are expected to show roughly a 1% month-on-month rise in headline prices, the fastest pace since 2022, with most of the jump coming from an estimated 23% surge in gasoline. Headline inflation is projected around 2.75 to 3% for the year, while core is closer to 2.5%, helped at the margin by lower tariffs but pressured by higher transport costs and firm technology input prices. The Federal Reserve is widely seen staying on hold, but the policy bias is becoming more asymmetric, with officials signaling openness to both hikes and cuts depending on how inflation and growth evolve, and other central banks such as the European Central Bank and the Bank of England are also inclined to buy time amid geopolitical uncertainty. Yields, however, have already moved higher. The U.S. 10-year has climbed to around 4.34%, reflecting not only concern that energy keeps inflation sticky, but also deeper worries about deficits, debt levels, and who will absorb the growing supply of government bonds. That has pushed the so-called term premium higher and contributed to days when bonds and equities sell off together, weakening the traditional diversification benefit of duration in multi-asset portfolios. Some strategists argue that if the oil shock ultimately hits growth harder than inflation, yields could fall again as recession risks rise and central banks pivot toward easing rather than further tightening. For now, market depth is thin, conviction is low, and rate expectations embed a relatively smooth path, leaving plenty of scope for repricing if either inflation overshoots or the energy shock proves more damaging to activity than currently assumed. In credit, the surface still looks calm. Investment-grade corporate bonds continue to attract strong demand from insurers and other long-term buyers, helped by relatively high starting yields and the perception that the Fed is on hold rather than preparing an imminent hike. High-yield spreads have tightened and, in many segments, sit near their narrowest levels in weeks, signaling sustained risk appetite even as macro uncertainty rises. That said, the quality of this tightness is uneven. Spreads on better-rated BB high-yield names remain compressed at roughly 200 basis points, while the weakest CCC-rated bank loans trade out at around 2,000 basis points, flashing a clear warning sign about stress at the bottom of the capital structure. Distressed desks have reportedly generated strong profits, shorting debt in vulnerable sectors such as software, showing that credit dispersion is already meaningful beneath the aggregate indices. The more acute pressure is in private credit, where rapid growth to roughly $1.8 trillion has coincided with looser underwriting and now a tougher refinancing backdrop. Retail-oriented funds are facing rising redemption requests, with some vehicles limiting withdrawals after sizable outflows and others projecting several more quarters of selling pressure. Liquidity is scarce in this market, especially under stress, so investors who expected easy access to capital are discovering that redemption gates and longer payout periods are part of the structure. By contrast, institutional-focused platforms, such as those run by large Wall Street firms and specialist managers, are seeing much more modest outflows and are actively preparing to deploy capital into dislocated assets at higher spreads and with tighter covenants. The key question for allocators is whether the combination of higher rates, expensive public spreads, and an energy shock eventually broadens today's concentrated pockets of stress into a fuller credit cycle that reaches mainstream high-yield and leveraged loans. Foreign exchange markets are strikingly calm given the geopolitical backdrop. Implied volatility in major currency pairs remains moderate, and positioning data suggests traders are wary of taking large directional bets ahead of key deadlines in the Iran standoff. Option markets, several months ahead, show little sign of panic, which implies that many participants still expect a managed outcome without lasting damage to global trade or growth. That stance sits uneasily alongside warnings that markets are underestimating the probability of prolonged energy infrastructure disruptions, which would likely weigh hardest on energy importing economies and their currencies. Alongside traditional currencies, digital assets are becoming a more visible part of the cross-asset conversation. Bitcoin has been notably resilient during the latest bouts of geopolitical tension, holding steady or even ticking higher on days when equities, bonds, and at times gold have been under pressure. Its realized volatility has fallen from around 80 to 90% last year to roughly 40% now, signaling a maturing market with broader participation. Sovereign wealth funds and other institutional investors, particularly in Gulf countries, are gradually allocating via exchange-traded products and mining ventures, turning Bitcoin into a small but increasingly relevant component of the global risk and liquidity mosaic. Commodities sit at the heart of today's macro story, with oil and refined products under intense pressure. Escalating confrontation between the U.S., its allies, and Iran, including reported explosions on Karg Island and threats to critical infrastructure, has lifted crude prices to around 6-month highs, with key benchmarks recently trading above $110 a barrel. Iran's partial closure of the Strait of Hormuz and talk of hefty per-ship charges have given it unusual leverage over global energy flows, while blockades affecting liquefied natural gas mean a significant share of global LNG supply is currently disrupted. Only a small number of tankers, mostly with regional flags, are reportedly passing the strait, and physical cargoes for prompt delivery are commanding sizable premiums as buyers worry about securing supply. Refined products look even tighter than crude, with jet fuel prices almost doubling since the start of the year and U.S. diesel above $5.50 per gallon, a combination that pinches airlines, trucking, and heavy industry worldwide. The macro implications are uncomfortably stagflationary. High energy costs act as a tax on consumers and businesses, raising the risk of demand destruction and recession if they persist. One scenario being discussed is that should the Strait of Hormuz remain effectively closed through April and oil spike into the $130 to $150 range, the probability of global downturn would rise sharply. Elevated refined product prices are already straining households, particularly in Europe and Asia, where alternatives to Middle Eastern supply are limited. This energy shock is a major reason why headline inflation is expected to jump about 1% month-on-month in the U.S., driven by gasoline, and why policymakers anticipate that global inflation will stay higher for longer as fuel and transport costs filter through supply chains. Gold is responding to this mix of geopolitical risk and inflation anxiety. After a spell of outflows linked in part to central bank selling, the metal is seeing renewed demand as a perceived safe haven and as a complement to disappointing bond performance and very tight credit spreads. Some strategists describe gold as a high-convexity position from here, arguing that downside looks limited while upside could be substantial under protracted stress, with some 12-month price targets set far above current levels. There have been days recently when crude benchmarks eased while gold climbed, hinting at a subtle rotation within commodities from pure growth exposure toward assets associated with capital preservation. At the same time, if the worst-case oil scenario did tip the world into recession, high-quality fixed income could reclaim its traditional role as the primary portfolio hedge, leaving allocators to weigh how to balance duration, gold, and even digital assets as complementary buffers against the ongoing energy shock. Across assets, the picture is one of resilience wrapped in fragility. Equities still lean on strong earnings and powerful AI-driven growth, yet sit uneasily alongside an oil shock that has historically preceded larger drawdowns and a consumer that is only starting to feel the full force of higher fuel costs. Rates markets price in sticky inflation and higher deficits, pushing yields up and diluting the hedging power of duration, while credit spreads stay tight on the surface even as private credit and the weakest borrowers show mounting strain. In FX, volatility looks too calm for the geopolitical backdrop, and the behavior of gold and even Bitcoin suggests investors are quietly rebuilding shock absorbers while headline indices remain composed. For allocators, the key watch points now are the trajectory of Middle East supply disruptions, the coming run of inflation and earnings data, and any signs that stress in private credit or lower-rated credit migrates into core public markets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.